Growth equity is a category of investing that typically lies in between venture capital and private equity. And the trajectory of growth equity as a category has really been remarkable over the last decade. Largely due to the success of software, SaaS, and payments businesses, there have been a lot of fast-growing businesses that have enabled this kind of investing. In this video, we're going to talk about some of the key characteristics that comprise growth equity investing, as well as go over the main funds in the space and some tips that you can use for recruiting. So like pretty much every other kind of investing, there aren't always going to be concrete definitions for what something is. However, I think that if you look at a lot of the firms that brand themselves as growth equity, they often have the following characteristics. A lot of these growth equity firms primarily invest between that Series B to maybe Series D or E range. And what that typically means is they're deploying investment sizes or participating in rounds in which at least $30 million has been deployed. That's the average size for a Series B round. And once you get to that Series D round, you can be deploying $100 to $300 million of capital. And a lot of the times at this range, you're dealing with companies with an enterprise value in excess of $1 billion. And I would say a lot of traditional private equity firms also invest in Series C and Series D. So Series by itself is a decent parameter, but it's by no means prescriptive. Another very common characteristic of growth equity firms is that they invest in businesses that quite simply grow. They're often going to invest in companies that have above 20% revenue CAGR, growing very quickly. And when I'm looking at revenue CAGR, I'm really looking at the top line projections of this business. I think that it's going to continue growing its revenue, continue gaining share. This characteristic does borrow from the venture capital style of investing, looking for fast-growing businesses that can disrupt an industry, whereas a lot of private equity businesses don't have to necessarily grow revenue. Oftentimes, they're just looking at EBITDA because that's what they're levering off of. Another giveaway that a firm thinks of itself as a growth equity firm is that in the press release, they'll often talk about using the investment money for growth. They'll very likely explicitly call out the word growth and then talk about something specific that the money is going to be used for. They might say they're building a new factory, expanding a particular product, or maybe moving internationally. A couple of other criteria that are more common in growth equity. One is that they tend to do more minority investing than private equity. They aren't as focused on taking a full controlling position. And one other thing is that they often aren't going to be using debt or LBO mechanics quite as heavily as in private equity. Now, one of the most common questions I get for growth equity recruiting is how much do you need to do for modeling? And honestly, my recommendation is just to learn the LBO model test anyway. There's way more high quality resources for LBO models, and honestly, the mechanics are extremely similar. There are a couple of key differences. One is that you likely aren't going to be using as much debt. Another is that you need to be comfortable modeling preferred securities. That's much more common in growth equity and should also be much more common with management options and minority investing. But if you break it down to its brass tacks, the growth equity and private equity model are almost the exact same thing. It's just that the metrics and different tools you use are different in growth equity, and we do have great examples in our private equity course on our website at peakframeworks.com. Additionally, just make sure that you can do the structuring parts. We have a free article that talks about the difference between convertible preferred as well as participating preferred, and this is just one of those things you need to know in growth equity. The other main thing I think you need to do is follow technology trends. I think it's very useful to borrow information that people in VC are using because they create so much content. I would just follow a couple of highly reputable VC blogs to make sure that you understand the space that you're recruiting for. And finally, just like every other category of investing, you should make sure you have a growth equity pitch. It's very straightforward to just look at the company's portfolio, look at a company that they purchased recently, and then just look for a competitor or a similar business, look up its financials, and be ready to pitch it in under a minute. So next, I just want to paint a picture of who some of the largest growth equity firms in the business are. And I was actually really amazed looking at the amounts of money that these companies have raised. On average, growth equity funds are going to be smaller than private equity. That's because they're investing earlier on in the stage. They're deploying smaller checks. The same is true for venture capital funds. Venture capital funds, on average, are even smaller than that of growth equity. And that's because they're writing smaller checks in smaller companies. If we look at this list of growth equity firms, there are only 5 firms as of Q3 2022 that have more than $5 billion in their latest fund. I've said this before, but I like to look at latest fund size more than AUM because AUM often rewards firms that have been around for a very long time, while fund size really just focuses on how a fund is doing in this present day. Now, Insight Partners by far has the largest fund at $20 billion. And I just want to compare this to some of the large cap private equity funds. A lot of the large cap private equity funds are not even this large. A lot of the major players only have between $10 and $15 billion in terms of their latest fund. So it is really impressive that Insight Partners can raise this much money more under a growth mandate. Tiger Global impressively was still able to raise $12.7 billion. TA Associates, which often blurs the line of private equity, has a fund of $12.5 billion. And then you have Summit and General Atlantic, which have about $8 billion each. I also want to point out in this list, a lot of the funds here have some kind of relationship or some association with a mega fund or large cap private equity firm. Blackstone Growth, of course, is an arm of Blackstone. PSG started under Providence, and TPG Growth, of course, is associated with TPG. And that's because a lot of these large cap asset managers, their goal is essentially to amass as many assets as possible. And that covers different asset classes. And because of the popularity of growth equity, a lot of these asset managers have entered the space. So hopefully this was a helpful overview for you. I really do think growth equity is a great space to be in. It combines a lot of the diligence and investing style of private equity, but applies it to more technology-focused businesses like in VC, and it tends to have a little bit better lifestyle. So thank you for watching, and I'll see you in the next one.